So we get a lot of clients who get confused about all the different legal exemptions we start talking about when it comes to raising capital for a real estate syndication or setting up any type of fund, investment fund. There are different legal exemptions that apply that we need to fit whatever you're doing into to make sure you stay compliant with whatever law we're dealing with. So I'm going to go over quickly the three primary types of legal exemptions that we look for in creating syndications or funds when you're raising capital. So I'm going to share my screen and let's take a look at what we've got here. So, three primary legal exemptions for syndications and funds. What are the primary legal issues that we deal with when it comes to raising capital? Whether it's setting up the fund or actually going out and raising the actual capital. Securities Act of 1933, federal law. Exchange Act 34, so that's also a federal law. Exchange Act, Investment Advisors Act, Investment Company Act, and then general corporate tax and state law compliance. These are all things we have to take into account when creating any type of fund, syndication, raising capital, all of those. We have to take those into account. If you're coming to a securities lawyer, they should be looking at all of these issues. When do those legal issues apply? So anytime you have a company that's raising capital, bringing in investors for growth or startup money or working capital, anytime they're going out and raising capital, or if you're creating some type of fund, company, whatever it is that's going to go raise capital. So like a fund raising money, if you set up a hedge fund, private equity, a debt fund, real estate fund, that's when these legal issues are going to come into play. Also, when you're looking for investors for real estate deals, syndications, creating a fund, almost anytime you bring in a passive investor in and you're offering them some kind of return, it deals with what's called the Howey test by the SEC, but it looks at essentially something pooling their money together, expecting to get some kind of a return on their money in exchange for you managing the deal. Basically, you're going to actively basically take the asset and increase its value, however it is, whatever type of asset. If it's a hedge fund, you're trading stocks maybe. If it's a real estate, you're developing a property and then selling it for a profit. And that's the return you're offering for the passive investors. And they're not the ones doing the actual trading or the actual finding the property, developing it. This applies to things like promissory notes, debt, preferred equity, stock, common equity, LLC interests, limited partnership interests, all of that. So what's the first primary exemption that we have to look at? The Securities Act of 1933, and this is dealing with primarily ownership or investment terms. So this is dealing with securities when you're offering and selling a security, in other words, bringing in investors. When somebody's going to become a stockholder, a limited partner, an owner of your LLC, usually the Securities Act of 1933 is something we look to for your offering of that security specifically. The general rule is cannot offer or sell a security without registration with the SEC or finding an exemption. Registration with the SEC is a complex and timely process, so we normally want to look for an exemption. So let's define what is a security, because if I can't offer and sell a security, what exactly is a security? Well, the SEC's definition is about 2 pages long. It includes just about anything you could think of under the sun: stock, LLC interests, units, promissory notes, limited partnership, sometimes even joint ventures or contractual arrangements can be a security. Crypto, the SEC has started saying that pretty much most crypto is a security in most cases. So what are those exemptions that we're looking for so that you can go out and offer and sell and bring in investors to your deal? Regulation A is an exemption. That's called a mini IPO. It's too complex for this presentation today, but a Reg A is like a mini IPO. It's a partial registration with the SEC, and you can go up to $75 million in rate that you can raise. Reg CF, or crowdfunding, this is where you're usually bringing in smaller check size from investors, like $1,000, $5,000 a piece. These are usually smaller deals. You can raise up to $5 million. Reg D, this is the primary way people privately raise capital and do securities offerings. And Reg D has been broken down into two primary sections, 506B and 506C. 506B is for accredited investors and up to 35 non-accredited investors. You can't solicit or go out to post on Facebook or anything to raise money this way. So 506C, you can raise capital publicly. You can put it on social media, but you're limited to only accredited investors, and you have to independently verify that they are accredited. So the SEC has said 506C, yes, you can go start advertising online and go generally solicit to people you don't even know, but you have to take this extra step of only dealing with accredited investors and also independently verifying, that they actually are accredited. And this is just to protect the investors, to make sure that they have the financial sophistication to understand what they're investing and the risks, and also the financial wherewithal to potentially lose their investment and it not bankrupt them. Now, there's a number of other securities offering exemptions. Those were the primary ones. So what is the second primary exemption that we're looking for when you're dealing with funds? Investment Company Act. Now, this one, I basically explain it to people as this is the actual company or fund offering an investment. So if it's an LLC that was created, if it's a limited partnership, a corporation, the one actually offering an investment to investors is something you have to look at to see whether the Investment Company Act applies. The general rule is an investment company must register with the SEC or find an exemption. And registration is a lengthy, timely process that most people want to avoid. So what is an investment company? Investment company is in the business of trading, investing in, owning securities. So if, for example, if you have a real estate syndication and it's just investing in one project, that LLC that's investing in the project and raising money from investors may not technically be an investment company because it might not necessarily be in the business of trading, investing in, or owning securities if it's basically just buying one piece of real estate and developing it and then selling it. So it may not even fall within the category of defined investment company, but it's still something we have to look at. More commonly, this comes up when you're dealing with a fund. Whatever type of fund you create, if it's especially a hedge fund, obviously you're trading in securities. You're buying and selling stock or commodities or options. That fits the definition 100%. A hedge fund would fit within this category. A lot of other types of funds potentially are an investment company. And so we still need to look at what exemptions can we use for those types of funds. Under the Investment Company Act, there's a couple primary ones that I'll cover. 3C1, you can have up to 100 investors, or if you're a qualified venture capital company, you can actually go up to 250 investors, shareholders. And this is independent of the whole accredited investor. Each of these three exemptions and three different laws are independent of each other. They kind of overlap, but they're completely different analysis. So when I say you're a 3C1 up to 100 investors, that's independent of if you're doing a 506B or 506C, and you can have up to 35 non-accredited. That's a completely different analysis. That has to do with the actual security you're offering. The Investment Company Act has to do with the actual fund you've created for the life of the fund, what it can do. So 3C1, you can have up to 100 investors or shareholders in, or 250 for a venture capital company. 3C5 is kind of a specialized, if you're investing potentially in real estate interests or debt, you can have an exemption here. 3C7, if everyone is a qualified purchaser, and this is basically going to be more like institutional and family office because it's a very high threshold to become a qualified purchaser. But if you're only going after pensions and like large investment institutions, they're probably qualified purchasers. So this is a an exemption that you might use to avoid registration as an investment company. 3C9, this is a little bit more specialized. Since I'm based in Texas, I will bring this one up, but it's not used that often. 3C9 is for certain oil and gas investments, and it's limited only to those investment companies that do oil and gas deals. The third primary exemption, the third law we have to deal with, the Investment Advisors Act. And this applies to the individual, the sponsor or the person or management company that's running the fund or the company or the LLC that's raising the capital. So this third exemption really deals with the person who's running the deal and whether they have to register as an investment advisor. The general rule is someone who is compensated for advising someone else about securities investments has to register with the SEC and follow certain regulations designed to protect investors, or if there's an exemption. So the exemptions from registration, and first of all, going back to the general rule, someone who's compensated for advising others about securities investments. If you are the manager of an LLC that's doing a syndication and you're only investing in, you're buying a project, you're buying an apartment complex through the LLC and nothing else. That's it. You're just buying this investment property. You probably don't fit in this general rule of being compensated for advising others about securities investments, because buying real estate, be it buying an apartment complex, is not a securities investment. So again, in a syndication, a lot of times this doesn't necessarily apply. What are some of the exemptions? So if you're under $150 million in assets under management, meaning if you're a manager or an investment advisor and you create a fund and you raise $130 million and you deploy that capital, you have $130 million of assets under management, or AUM is what most people call it. You're exempt from having to register with the SEC. However, under that threshold, $150 million is where you have to register at the SEC. Under that, there's some complex regulations, and it's too detailed to get into today, but based on the state and how much you've raised, if you're under $25 million in assets under management, generally there's no obligation to register with the SEC or the state where you're located. As an investment advisor, you're exempt completely. Between $25 million and $100 million in assets under management, you're usually required to register with the state as an investment advisor, but you cannot register with the SEC. You can only register on the state level. And there are certain things like an exempt reporting advisor. I didn't put that on the slide, but the primary one that we use for funds is if you're under this threshold, you qualify a lot of times as an exempt reporting advisor. So what we do is we file a form ADV with the state where you're primarily located and saying, okay, this is a $50 million fund, 50 million. And so we're registering with the state as an exempt reporting advisor, but we're not a full registered investment advisor. We didn't have to take any licensing tests. Basically, we file a form ADV, we comply with a certain number of rules, and we're okay. Once you get over 150 million, you need full registration as an investment advisor. That private exempt reporting advisor exemption no longer applies. So the exempt reporting advisor is sort of for these exemptions that we're talking about down here, the under $150 million in assets under management. So those are the three primary exemptions. So the first one deals with the actual company offering the investment. And that's the security that they're offering. Okay, right now I'm offering 1 million shares of common stock for $1 a piece. That's the number one exemption, whether it falls under like a Reg D offering. Second is the Investment Company Act. The company, LLC, that I created, corporation, is an investment company because it's trading and owning securities. And if so, do I need an exemption for it? So that's sort of the fund or company level. And then the third is the person running the deal, advising someone. Do they need to register as a investment advisor? Is there some kind of exemption available? What happens if you don't do this? I didn't list everything on here, but the SEC, state regulators can come after you for things like unregistered sales of securities, being an unregistered investment advisor, not registering an investment company. The SEC or the state can do things like take criminal action against you, civil fines and penalties. Basically, they can also put an order out saying that you can no longer rely on any exemption to raise money or create funds. Your investors may also have a rescission right, meaning the right to their full amount of money back plus interest, which can be a problem if you don't have that cash on hand. So those are some of the things to be concerned about, but those are the three primary exemptions. Hopefully this clarifies it a little bit. I'm going to put together a table and also post that so it kind of breaks down these three different areas. And thanks for watching.